Alright, so to start off, we'll go over a quote from Paul Simonson, who was an American economist and a Nobel Prize winner. He said, "Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas." So many people believe that investing in the stock market is kind of like gambling, but in reality, if you're patient and you know what you're doing, investing really isn't gambling. One of the benefits of investing is, of course, that it makes money work for you rather than you work for it. Investing in the stock market also provides greater returns than other securities like bonds. And if done correctly, if you invest in the long term, it will provide you with a more financially secure future. So I have a strong interest in investing, especially in the stock market. I am a finance major, so I have some knowledge of investing. And also for this presentation, I use credible investment related sources like Investopedia and NASDAQ and also eTrade.com. So first I'll explain how the stock market works and then I'll go over how to invest in it. First, I'll explain what stock is, why companies issue it. Next, I will go over things to look for when buying a stock. Then I will go over when to sell a stock. And finally, I will go over how to get started investing. So first, we must understand what a stock is. So a stock is basically fractional ownership of a company. So if you have a share of a company, basically you're part owner of that company. So why do companies issue it? Usually when they go public, they issue stock in order to help raise money for like expansion and just kind of help the business grow. And the price of that stock is determined by what the company is worth and also the amount of shares being issued. In my slides, on the second slide, I have like a diagram showing how money flows through the stock market. So now that we understand what stock is, we must also know what to look for when buying it. So one of the first things is you have to know the business. One of the greatest investors of all time, Warren Buffett, stresses this a lot. Um, Before you invest into a business, you have to know how the business makes money, and also you have to know important drivers that impact the industry, so like competitors and regulations, that kind of thing. So after understanding the business, we can look at more technical measures. For example, a PE ratio. Definition is the ratio for valuing a company that measures its current share price relative to its price per share earnings. That's from Investopedia. So basically, the PE ratio represents how much you're willing to pay per dollar of the company's revenue. For example, if PE ratio is 100, then basically that means you're willing to pay $100 for every dollar of the company's earnings. When looking at PE ratios, we want to compare within the same sector, because PE ratio differs from sector to sector. So when comparing, you want to make sure they're comparable. We have another quote from Investopedia. In general, a high PE suggests that investors are expecting higher earnings growth in the future compared to companies with a lower PE. Lower PE can indicate that either that a company may be currently be undervalued or that the company is doing exceptionally well relative to its past trends. So another thing to look for is beta. Beta basically just measures the share's volatility. So it's in comparison to 1, which represents the market. So if beta is greater than 1, that means that beta is more riskier than the market. If it's less than 1, then it's safer than the market. Another thing to look at is the company's chart. So basically, in simplest terms, you want to just make sure that it is increasing steadily. So you want it to start at the bottom left and go up the top right. And also, you just want to make sure when buying a stock, do not look solely at the price. Many people make that mistake of just looking at the price. That should be one of the things, but not the only thing you look at when buying. I have an example of Amazon on the slides. I took basically just a snip of Yahoo Finance on Amazon's first page, and it goes over all of that. It goes as the PE ratio, the chart, beta, volume, and a bunch of other information you can find on there. So once we have stock, how do we know when to sell it? First off, you don't want to be a day trader. Investing in the stock market is for the long term. Many professional investors recommend holding the stock for at least 5 years, preferably even more than that. And the reason being, as the longer you hold the stock, the more profitable it becomes over the long run. But another reason you might want to sell a stock is when it becomes overvalued. So for example, the PE ratio is too high, or when a company loses its competitive advantage. I have a quote here from NASDAQ. Whether it's through a superior product, manpower, lower prices, patents, or technology, a company's competitive advantage is the wall that keeps competitors from taking away market share and profits. So just an example of this is what happened to Blockbuster. It used to be, pretty big company. It was pretty successful until Netflix came around and changed all that. Basically, that's exactly what happened was Blockbuster lost its competitive advantage, and earnings began to drop, and Netflix eventually just put it out of business. So now that we understand the fundamentals of the stock market, what stock is, how we buy stock, and how to sell stock, how do we get started investing? So I have on my slides, on the fourth slide, I have basically the pros and cons of doing it on your own and the pros and cons of having a professional like an advisor or planner help you. So on your own, there's a couple of ways. There's apps like Stash and Robinhood, which are, you can download it for free. And those are pretty simple. They don't require much to get started. You can deposit $5, $10 and get started investing. Another option is using E-Trade from its website. E-Trade is the leading financial services company and pioneer in the online brokerage industry, having executed the first ever electronic trade by an individual investor more than 30 years ago. The company has long been at the forefront of the digital revolution, focused on delivering complete and easy-to-use solutions for traders, investors, and stock plan participants. So while E-Trade does require a little bit higher deposit, it requires I think a couple hundred, and it also has more fees. But on the upside, you also get kind of more help on demand, professionals to help you. And so the other option is using like a local financial planner slash advisor. One of the things that uh, the advantage of that is it offers convenience. I mean, they pretty much take care of investing for you, and it also offers peace of mind knowing that you have a professional, an actual professional, um, going over and investing your money. Another option is mutual funds, so it's kind of a combination of doing it on your own but still having some help. So a mutual fund basically is a diversified portfolio consisting of a lot of different stocks, but it has a professional managing that portfolio. So in conclusion, I explained what the stock market is and how to get started investing. First, I explained what stock is and why companies issue it. Next, I reviewed what to look for when buying it. Then I went over when to sell the stock, and finally I explained how to get started. So just to finish, I'd say that stocks have been proven to provide greater returns than other securities like bonds and bills. So if you do it right and hold it for the long term, it really will provide a really secure financial future for you. So just make sure you get started as early as possible and keep the money invested for as long as possible.